Thank you. I must confess I'm surprised that 23% of us were in financial services in 1987, because at lunch I was the one that said no, there's only about 4 people that were doing super in 1987, and I picked 2 of them being Gary Weaven and Barry Watchhorn, but clearly there are a lot more of you. I'm going to talk about how funds have changed since 1987 and whether that's better prepared us to weather future crashes. But before I start, I just wanted to set the scene for those X% of you that weren't born in 1987, and on the screen we have the leaders of the time. We've got Bob Hawke, the Iron Lady, and Ronald Reagan. Also wanted to bring you back to the iconic images, being the mullet for men, where, very short hair in the front and long at the back, and for women, those fantastic shoulder pads, which I remember wearing, and it used to make me as wide as I am tall. We also had the mobile phone, which, for those of us that are permanently attached to our BlackBerry, it was a bit harder in those days, and indeed I'm told that that was the status symbol for 1987, and it came with its own wristband, so we could all carry it around our wrist and just sort of play with it day to day. And then we also have the desktop computer, which in those days literally did take up the entire desk. But today, computers have got a lot smaller, they're more powerful, they're integrated into our everyday life. In 1987, we saw the beginning of the 3% superannuation contribution being received by workers, and that followed a national wage case in the mid-80s. We also saw the establishment of industry funds, which were not-for-profit vehicles established to capture this 3% super contribution. Since that time, funds have got a lot bigger, they've got more sophisticated, and I'm hopeful that superannuation, just like technology, has become much more integral to our members' everyday life. I've been asked to talk about how things have changed since 1987 from a fund perspective, specifically the changes that have happened to Australian super since that time, how our portfolio and our members have needed to adapt, and how we manage our portfolio and risks for members. But just before I go to that, I've got a question that will just come on screen, which is regarding who should bear the liability for members' savings. Should it be members, employers, the trustee, a combination of the above, or should it be fund managers? A combination of the above, and that will fit into a theme that I'll talk about when I talk about Australian Super's approach to where it sits on the spectrum of paternalism. But I might just start off with what Australian retirement funds investment looked like in the late 80s, and I couldn't find any data for 1987, so I've gone to 1989, and should mention ARF was one of the 3 funds which formed Australian Super. So it was one of our predecessor funds. In 1989, the 3% employers' super contribution was still being rolled out industry by industry, and so only around half of Australian workers had any superannuation. Australian Retirement Fund had assets of 76.3 million, of which 90%, being 68.7 million, was invested with one manager in one product. We had 2 other managers, we had 181,000 members, and our average account balance was 420, not enough to withstand a crash. By 2011, following the merger with STA and FinSuper, Australian Super had grown to $37 billion under management, approximately 1.5 million members. Our average account balance had grown to 24,600, and we've got several hundred members with balances over $1 million. While we've increased our funds under management, we've also increased our skill, the experience and our resources within the trustee office, and indeed that's true for the industry overall. Our investment portfolio is more sophisticated. We've now got around 70 investment managers, and our mandates are generally around 200 million or larger. We've got 16 investment options, with the balanced option being our default, and indeed that's where 80% of our members have their funds. What else has changed since that time? Well, as they say, money changes everything. Our growth in funds under management not only reflects the growth in the SG and the compounding of investment returns, but importantly it also reflects a trend to fund consolidation. Where the 80s was a period of fund establishment, we're currently in a period of consolidation, and the latest APRA stats show that there are less than 400 main funds today. We've had to continuously evolve to meet the needs of our members with greater account balances, and while super is still undeniably a low engagement product, we are seeing member interest increase as their account balances increases. What else has changed? Clearly, expectations have changed. As I've said, we've seen members' interest increase as their account balances increase. And if you put in the context of workers having to stay in paid employment longer, super contributions increasing to hopefully 12% and above, and account balances growing, this level of increased member interest is something that I think will continue. Just on expectations, Australian Super had conducted a survey last year of expectations of investment returns. And in a survey of the working population, we asked what rate of return did people expect from their super. 41% said they expected under 10%, 45% said they expected 10 to 20%, and 14% said they expected over 20%. So some people clearly have forgotten about the GFC and are giving a challenge to our investment managers who are going to follow me. The other thing that's changed clearly is attention from regulators. With assets now at 1.3 trillion, a figure that in 1987 I don't think any of us expected, we've seen increased attention from regulators, and I don't think that's a bad thing. We've gone from the Insurance and Superannuation Commission in 1987 through the SIS Act. We've now got regulatory oversight by APRA, ASIC and the ATO. We've had the Financial Services Reform Act, and recently we've had the Cooper Review and Stronger Super. Not only have regulators increased their supervision, but the attention that they're giving now extends way beyond the issues that they talked to us about in the late 80s. They're now looking at things like liquidity, risk management, best practice, to issues such as cloud computing, which again, I'm only learning about now. So in 1987, I don't think that ever actually was even a term. Importantly, we expect more of ourselves than we did in 1987, and we expect more of our managers and our advisors. We've got a much deeper appreciation of the costs within our portfolios, the drivers of value, how to capture economies of scale, and we're consistently focused on increasing the net benefit to members. In terms of Australian Super's investment, our portfolio has certainly increased in both size and sophistication. Our asset allocation process and strategy has continued to evolve, and pleasingly, asset allocation has continued to be the main source of our long-term outperformance. We've increased our knowledge and skill in investments, in particular unlisted investments such as infrastructure and property, and these have been excellent sources of long-term return for our members. Increased liquidity from our greater scale has been an important contributor to our investment strategy, and it's given us a flexibility both in terms of investment opportunities and weathering the GFC that wouldn't be possible if we were much smaller. We've now got many more managers and we've got larger mandates, which means that we have to constantly examine our portfolio to ensure that we're capturing the economies of scale. In 2009, we streamlined our Australian equities portfolio. We had fewer managers, we ended up with much the same stock coverage, and we took out $7 million in costs. It's also interesting to reflect that the fund is now much larger than many of its investment managers. And what that's done is changed the source of some of the R&D and intellectual thinking. We're doing much more internally around issues such as climate change and risk budgeting, where previously we would have outsourced those. And as Mark Delaney said in the promo, we've got the resources really to unpack the investment offers before us, where we can drill down on issues such as transparency and understanding the structures, and we're not reliant on external advice. We've got an internal investment team which is far larger than the fund's full staffing 20 years ago. We've got a well-defined investment decision-making process which involves considerable interaction between the investment committee, our in-house team, and our external advisors. Within the investment department, we've got teams dedicated to 3 broad asset classes, as well as an operations team and a portfolio construction team. Our investment committee includes members with particular expertise in economic policy and alternative assets. And that expertise has enabled us to be a much more active investor than we've been in the past, and also helped us to implement our core investment beliefs, which include a preparedness to adjust our asset allocation in response to market conditions. At a national policy level, members have been urged to become much more engaged in and sophisticated about their superannuation. As I've noted previously, we've got 16 investment options, and while we certainly give members more choice than we did in 1987, we're still very conscious that most members are happy not to exercise choice. That means the trustee has an even greater obligation to ensure that our default offers are in the best interests of most of our members. And we recently commissioned research to investigate the optimal design for our default fund without any predisposed view of what that end product would be. In giving our members choices, we're also conscious that we need to provide them with information, we need to be able to answer their questions, and we need to help them make informed decisions. It's true that some members will make bad decisions, but it's also true that other members will make sound decisions that reflect their own circumstances and investment horizons. At Australian Super, the discussion is how to best meet the needs of our members. And that involves such questions as, should we be more or less paternalistic? How do we educate members about risk? How do we protect them? And how much agency risk should a member have? We know that we've got responsibilities as a fiduciary, but there's a spectrum of paternalism for a trustee to consider. And each trustee needs to decide where it sits on that spectrum. At one end, a trustee could offer its members no choices and carry the full responsibility for their investment outcomes. At the other end, a trustee could offer unlimited choice and have a much more limited liability for member outcomes. Having progressed from a very paternalistic position of a single default offer and maintenance of investment reserves, Australian Super now balances paternalism with choice. And there are 3 principles which underpin our position. These are that we're committed to providing members with an excellent default, both in terms of investment and insurance. We provide members with an appropriate selection of investment choices, not so many as to inhibit choice, nor so many as to be inefficient. And we're committed to providing members with access to knowledge and services to help them exercise informed choice, and we do that through a variety of channels, including face-to-face, print, web, and the phone. So I hope that's helped you see how super has changed since 1987, and I look forward to hearing from my colleagues about how we can avoid the crashes of the past. Thank you.
Well, thank you. It was certainly a long trip, but it's always nice to be in Australia. It's a wonderful country. And after flying all that distance, it always amazes me that you actually don't really feel like you left home, because things are so similar between when you get off, the language, many of the sites. I want to talk today about two main things. One is the nature of market crashes and relating that back to 1987 and what we recently experienced in 2008, and then how investment managers should avoid that going forward, and certainly superannuation funds as well, and talk a little bit about those ideas. So the first thing I want to just talk about is that crashes are inevitable. As long as there's fear and greed in markets, there will be return and risk in markets, and there will be overshoots both ways, both to the upside and to the downside. But the one thing that is crucially important in terms of whether those market crashes are just temporary events, in which case wealth is restored over a fairly short period of time, or whether those crashes are debilitating in terms of wealth destruction, is the role of debt. Debt and the ability of central banks to cut interest rates to bring interest servicing costs down on that stock of debt. The page that you're seeing on the screen right now is an example of the United States, because the United States, of course, was at the epicenter of the most recent crisis. The chart on the left shows total debt as a percentage of the economy. And what you can see is that the total debt as a percentage of the economy topped out at, let's say, between 350 and 400%. That's an enormous figure. But that's actually not the crucial point. The crucial point is that as debt goes higher, interest rates have to keep falling in order to keep that debt from being a suffocating, stomping shoe on the back of investors. And as you can see on the chart on the right, where the blue line are short-term interest rates and the red line is long-term interest rates, that essentially for the last 30 years, we've seen nothing but interest rates go down and down and down. The one big difference between 1987 and today is that in 1987, while there was a significant amount of debt in the economy, interest rates were at plenty high levels so that when the crash came, the Federal Reserve could cut interest rates, and that meant that a recovery could be experienced because there was enough liquidity in the system. In 2008, as you can see, that blue line hit zero. And when that blue line hits zero, it becomes very, very difficult for a central bank to actually liquefy the system and create a market recovery that's sustainable and quick. And that example that you see in the United States was true basically for half of the world. This is the crash, the buildup, the crash, and the recovery in 1987. You can see here that the impetus for that crash was the tightening that occurred in the year previous to 1987. Then we got that big, sudden 20% drop in stocks, but notice how quickly that market recovered. Why? Because interest rates were cut quickly and there was plenty of room to cut interest rates to liquefy the system. Let's compare that to Japan. You can see that between 1986 and 1990, the stock market in Japan grew exponentially, but so did debt. And when the crash came, it was significant, but most importantly, the Bank of Japan hit the zero interest rate line, and they couldn't cut interest rates below that, and they didn't do any extraordinary measures beyond that to liquefy the system. And so for the next 20 years after that, basically the stock market has hovered in a pretty significant range and never recovered the wealth from that period. Even today, in Europe, we have a real-time situation of this phenomenon. On the left graph, I want to compare the blue bar and the red bar. First of all, on that left graph towards the left is Germany. Notice that in 2002, which is the blue bar, debt to GDP was essentially at the same level as the red bar, which is today. That's Germany. But then there's Ireland, which is the next pair of bar charts there. In Ireland, you can see that in 2002, debt to GDP was just over 100%. But today, that figure is more like 260%. Now, the interesting thing about Germany and Ireland is that over that time frame, they have the same currency and the same central bank. So interestingly, although the ECB liquefied the system, basically rates hit roughly zero. And now, while Germany recovered, which is what you can see on the right graph, that's because they were never over-indebted. Ireland never did. And Ireland just basically scrapes along the bottom, even with the stimulus that was put into place. So, I'm saying here that crashes are always going to happen. It's like fear and greed. It's part of human nature. But the true wealth destruction is a function of how big debt is and the room that the central bank has to liquefy the system in the aftermath of the crash. With that, let me stop for a moment and ask a question. And that is, which of the following strategies help protect your super from the next market crash? 1, tail risk hedging, meaning buying insurance on the portfolio. 2, essentially dynamic asset allocation with a 10% leeway to try and get ahead of these crashes. 3, doubling your allocation to alternative investments that hopefully would not be correlated to the asset allocation. Or 4, avoiding in the asset allocation concentration to any single asset class. Isn't that interesting? And I can tell you right now that that's very gratifying to see, because I would say that throughout some of my experiences in Australia, and frankly throughout the world, that most of the answers would have basically gone to number 2, but today I see that number 4 is gaining the overwhelming majority. I want to talk about that in terms of some interesting thoughts. First of all, on this question of adjusting the portfolio, let me take a 60-40 portfolio and pretend for a moment that if we adjusted the portfolio in advance of a crash, that we were perfect. We had perfect foresight. Let me show you what that would be worth. If you had perfect foresight from moving to equities to bonds before a crash, and you did it with 10% of the portfolio, you can see that you would add 140 basis points to the bottom line. If you did the same thing with 20%, you'd add 2.9%, and if you did the same thing with 30%, you'd add 430 basis points. So clearly, alpha, that is skill in beating the markets, is important. But having said that, most plans, I would argue, don't really go beyond a 10% type of shift. And this is with perfect foresight. Let's just take a look at an example of how hard it actually is to have perfect foresight. I love this example. In 1996, Alan Greenspan, who was then chairman of the Federal Reserve, made a famous speech. Do any of you remember this? He asked a question, this was December of 1996, because he was worried about a bubble forming in the U.S. stock market. And he said, I want to ask, he was saying to his audience, whether stocks or investors in stocks are acting irrationally exuberant. Essentially, he was warning that the Federal Reserve was grappling with the question as to whether stocks were in a bubble. From that day, for the next 5 years, if you had shorted the U.S. NASDAQ, which is the market particularly he was talking about, you still wouldn't have made money, even though ultimately that would have been a great trade. And then let's go one step further. Let's say that at that point that the chairman of the Federal Reserve was warning you, you didn't take action. You waited until the price-earnings multiple of the NASDAQ was at an all-time high of 50, that valuations had never been seen in modern days that high, which was a number of years later, in 1999. If you had shorted the NASDAQ then and held that position, it still would have taken you 3 years to actually make money. So it's really, really hard to beat the market, even though it's really, really valuable. So I would argue we've got to take advantage of all the tools we have if we're going to deal with market crashes and survive coming out the other end. So let's talk about what you mentioned, which is avoiding concentration in any single asset class. This is the reality of a typical superannuation fund here in Australia. The pie on the left is a typical capital allocation where the red slices are by and large equities or different types of equities with lots of other things from infrastructure to bonds represented in the other slices. Now, because equities happen to be one of the most volatile asset classes of all the asset classes, the true reality is the pie on the right is the real reflection. That's the risk allocation that matters most. As risk goes, so will go the portfolio. So as you can see, and by the way, this is not just true in Australia. This is a global phenomenon. The United States, the UK, Australia, broader Europe, a global phenomenon. So what that means is that as stocks go, by and large, so will pension funds around the world. And that's a problem because if stocks are not in favor, as this example shows, then there's a problem with the portfolio. On the left side, we show you a graph of Japan over the last 20 years, where the green line is the average return of Japanese equities over the long term. And the blue bands around that are 2 standard deviations of volatility around that average. Japanese stocks over the last 20 years have actually underperformed that 2 standard deviation band. That's a 1 in 4,000 year chance if you believe a statistical approach is warranted. Even U.S. equities over the last 10 years, the same thing, 1 in 120 years. The truth is, concentration in anything is bad because these kinds of outcomes, one shouldn't follow statistics because they happen way too often. So if I just took stocks and bonds and put an equal amount of risk to them, I just want to show you just 2 asset classes, avoiding a concentration in both, that a better portfolio can be had. Stocks, a 12.7 annualized return over 40 years with 14% volatility for a 0.29 return to risk ratio. Bonds at the same risk, so you have to buy longer maturity bonds, 13.9% return, same volatility, a little bit higher return to risk ratio. Now, I have no idea of whether that'll flip over the next 40 years or be the same or what have you, but this I know, if you put the two together, you're going to have a better outcome. And you can see over the last 40 years, you would have had 13.7% annualized returns and a lot less risk, 10.8%, 0.48 units of return per unit of risk. And that's just with two assets. So avoiding concentration in a single asset class is really, really important, as is getting good alpha. If you put the two together, that's going to be your highest probability of success. And this is what you see here. You can see that if you did that, a 60-40 portfolio with perfect foresight, moving 10% of the portfolio, that's the red line. The blue line is just that risk balance portfolio. Both those things were comparable for the last 40 years. Imagine what you could do if you put them together. That's my message today, that while it's impossible to predict crashes are going to happen, combining good active management and a move away from concentration is the highest probability of success for dealing with crashes that inevitably will come. Thank you very much.
My role is to talk about the lessons we've learned, and as the final speaker on a long day, I can tell you that I have checked off that every one of the 4 points I want to make has been made by at least one person before. And far from upsetting me, this gives me confidence that there are at least 4 people, I suspect one for each, who will not disagree with what I have to say. Now, it's a rare conference where Sherlock Holmes is invoked twice in one day, but Rob Pruget did that earlier today. And I want to remind you of a story that you may not be familiar with Holmes, but you will certainly have heard of this story. It's the one in which he solves the mystery of the missing horse, Silver Blaze. And it's the one in which he directs the Scotland Yard detective to what he calls the curious incident of the dog in the night. The dog did nothing in the night, said the detective. That, says Holmes, was the curious incident. And I mention this because sometimes it's important to notice what doesn't happen. And so today I want to draw your attention to 2 lessons learned and 2 lessons not learned. Now, no formulae, no diagrams, no PowerPoint over here. Everything is based simply on what another favorite fictional character of mine, Jeeves, would call the psychology of the individual. Although much more grandly today we call it behavioral finance, or if we really want to boast, we say neuroeconomics. So here's the first lesson we've all learned. Very simple. Risk is invariably greater than we assumed. Distributions have fatter tails than we assumed. Models are not the real world, even though they can be a useful representation of the real world. So in that sense, all models are wrong, but some are useful. And as a lesson for us all, a colleague of mine, Bob Colley, has noted that we shouldn't marry a model. And since he's an actuary, he felt it necessary to say a mathematical model, all human models are just fine to marry. Okay, so let's take this further. We're more risk averse than we thought. Well, why is that? It's because we discuss, and we did discuss risk as an abstract concept before we encountered it. And then we discovered, as another colleague of mine, John Gillies, put it, that risk has a friend called pain. And we tolerate pain less than we thought we could tolerate risk. And so de-risking is now the buzzword. And yes, of course, we need to strive for return, but losing money creates such a deep hole that it becomes tougher than ever to climb out of it. And so avoiding loss comes first, and it's fundamental. So that's the way I sum up my first lesson. We've learned that risk management is more important than return seeking. Well, so what? What does this mean for our behavior in the future? Well, there's a corollary for action. Risk varies over time. For example, equity market risk, whether we measure it by volatility or downside exposure, isn't constant. So let me suggest this as an exercise for you to go back and research yourself. Check out the VIX, the volatility index. Check out whether you think it's been a reasonably good predictor of actual future volatility. And if you think it is, doesn't it make sense to adjust your risk exposure accordingly? In other words, when the VIX increases, reduce your equity exposure so that your absolute standard deviation, expected standard deviation, stays unchanged. So go and check out for yourselves If you had done that throughout the GFC, what would it have done to your equity exposure? And then check out for yourself what that would have done to your return and to your downside. And if you're pleasantly surprised by what you find, perhaps you might consider incorporating that very simple rule as a very simple first step towards risk management in the future. Brett, in the interest of time, I'm going to skip the question. Okay. Here's the second lesson. Within that overall framework of risk management, we still need to seek return. Why? Because we don't contribute enough to achieve all our goals if all we get is the risk-free return. But what we've learnt is that risk exposure isn't constant over time, and we would also guess, therefore, that opportunities for reward aren't constant over time. And we can sum up this lesson in saying that the fundamental premise for return seeking has become more subtle. And this is what it is. It's, are there times when risk is more likely to be rewarded? Because if so, those are the times when we should focus on reward seeking. And I think the best we can do about this is intuition. Remember, all models are wrong, but some are useful. Anything more than intuition is just data mining. And what intuition says is, yes, opportunities ought to be greatest when markets seem to be at extreme points or just near extreme points. And we know because of human nature there will always be extreme points. There'll be, from time to time, excessive valuations, high points where greed dominates calm reasoning, or when we've forgotten how much risk there really is in the system. And there will also be, from time to time, excessively low valuations when panic, when risk aversion dominate, and that creates opportunities for those with a long-term horizon and a level head to make some money out of it. Of course, the big question is, how do you identify those points? From a model. Or rather, from a multiplicity of models, because you don't marry any one model. So what you do is, don't check the whole system together and say, is there a piece that's out of whack? Check two things at a time, pairwise exposures like equities against bonds, or domestic against foreign equities, or credits against government debt, that sort of thing. And that gives you a lot greater clarity than trying to sort through the entire picture all in one go. So check whether pairwise relative valuations are out of sync with long-term history, using many models, many perspectives. And what do? If the signals are confused, if the signals are contradictory, or even if the signals point in the same direction but not an awful lot, do nothing. Instead of don't just stand there, do something, don't just do something, stand there, do nothing. Because remember, risk control comes first. Only if these pairwise comparisons with multiple models give you strong multiple signals of being far away from normal should you do anything. And even then, don't bet the shop, just commit a small part of your risk budget to it. But it's a way to try to make return seeking more reliable within the bigger context of the even more important risk management. 2 lessons learned, now a lesson we haven't learned. Goals-based reporting. And this is essential for helping us to keep that level head that we really need. Let me give you an example, and it has to do with something very simple, an individual saving for retirement. Think of 2 jars, okay? First jar, this is money we're going to save for retirement. Gradually, what we're going to do over our lifetime is transfer money from that jar into a second jar. So every year we'll take a little and put it in the other jar, and in that second jar, that's the money we expose to the markets. Our goal is to maximize what we get from the sum of the 2 jars. When there's very little money in that second jar, the market jar, we can afford to take a lot of risk there and actually have very small risk exposure over the aggregate of the 2 jars combined. And what do we report on? We only ever report on that second jar, okay, the market jar. And so we exaggerate its importance. Of course, near retirement, it is that second jar that counts, because that's where everything is and there's almost nothing left in the first jar. But for most of our savings lives, that second jar, the market jar, matters very little because most of our retirement potential is still in the first jar. We can't get a sensible, level-headed perspective unless we report on the aggregate. And so if all we do is report on the market jar, we're going to get misleading signals, we're going to feel exaggerated joy, exaggerated panics as markets move, and we'll be impelled to take action in exaggerated ways because we have the wrong focus. And that's because we get reports on a part of the picture only, even though our goals are based on the whole picture. We all know the saying, what gets measured gets managed. Well, let's make sure that what we measure is a direct reflection of our goals. And finally, one last lesson we haven't learned, and we never will. And it is that we don't learn lessons. Well, that's not quite right. We learn lessons, but we forget the lessons that we've learned. That's really the lesson. And so we're going to have to learn them all over again. Or perhaps another generation will have to learn them all over again. And it's too bad that we can't hardwire these lessons into our psyche. At a time when we're feeling the pain, that should be hardwired into our psyche. In fact, what happens at a time when we're feeling the pain is that it's the amygdala that gets triggered and not the prefrontal cortex, which is where we have the reason, the calm reasoning, and the memory and all that stuff. It's always the triumph of the amygdala over the prefrontal cortex. I actually have a t-shirt. And on the front it says, resist the amygdala. And at the back it says, assist the prefrontal cortex. And I confess that I only look at that t-shirt occasionally. I mean, for all my reasoning, I'm a human being first and a thinking machine second. And I think that probably goes for all of us. So we'll probably all meet again in 10 or 20 years' time, and we'll have another vote as to what we were doing 20 years ago. And I'll say, I was talking about this stuff, except I forgot about it. And if we replay these observations, I bet they'll still be relevant. Rob Pruget reminded me that it was Santayana who said, those who don't learn from the past are condemned to repeat it. And on that cheery note, thank you for listening.